Hey YouTubers, welcome back to the channel. This is Everyday Finance and I'm your host Bobby. If this is your first time on the channel, welcome. Thank you guys so much for taking time out to watch this video. While you're here, if you enjoy this content, be sure to smash that like, subscribe, and don't forget to ring that notification bell so that you get updates on future content and videos similar to what you'll see in today's video. For today's video, we're going to talk about peer-to-peer lending and decide whether it's the right investment for you and your family. So without further ado, let's go ahead and jump right into it. Okay guys, so let's just jump right in with peer-to-peer lending. Now typically when people need money, they'll go to a financial institution or a bank, fill out the necessary forms, and then based on their credit worthiness, either be approved or denied a loan. Peer-to-peer lending, as the name suggests, allows people to lend or loan money directly to other people. This works two ways. One way is as an investment opportunity for people looking to make money off money they invest, and two, as an additional lending option for the public that may give better or more favorable terms for financing loans. So what's the big draw with peer-to-peer lending? So from an investment perspective, peer-to-peer lending allows you to take the place of the banks. You're able to earn more off of your money than you would if you were to take your money and place it into an account or a CD and just draw interest. In the past, placing money into a savings account or a CD were the standard way of earning additional income or interest on money that you had just laying around. Times have changed and these accounts are nearly a non-factor when it comes to earning money, as the returns are minimal at best. Peer-to-peer lending allows you to determine how much risk it is that you want to take on. Typically with these accounts, the higher the risk, the higher the interest rate that you'll be able to accrue on top of your original investment. In addition, you're able to cut or divest your money as much as you want in as small as $25 increments, so that you don't have all of your eggs in one basket when it comes to this as an investment. And also the interest rate is based on the credit worthiness of the borrower. As with any investment, there are risks involved. If you decide to go with the highest interest rate, you could potentially lose your money if the borrower does not pay that money back. But this is also dependent upon how much risk you're willing to take and what your financial and investment perspective is as well. Previously, the largest peer-to-peer lending network was Lending Club. There you could invest money and lend it out as much as you wanted, with the minimum investment being only $25. Unfortunately, Lending Club is no longer a peer-to-peer lending site as of August 2020. This was due to a change from focusing on retail or individual investors to focusing on institutional investors, as well as being acquired by Goldman Sachs. Currently, the major player in the peer-to-peer industry is Prosper, and I'll be doing a video soon to show the ins and outs of this as well. Now let's talk about the downside of peer-to-peer investing. The first thing is the fees. Typically, fees are something that borrowers incur on a loan, but with peer-to-peer lending, investors incur them as well. Lending Club charged 1% of the total loan amount, which doesn't seem like much if you've got a little money or a few dollars invested here. But if you're a major player, that small amount starts to add up. As an example, let's say that you have a loan for $10,000. Well, 1% of that $10,000 is $100. And if you start to multiply those fees start to add up. So as you can see, the larger your investments become, the larger the fees are overall. In addition, if you decide to take higher risk and the borrower defaults on the loan, you could serve a penalty that's up to 40% of the recovered funds. in the case of Lending Club. Another downside of peer-to-peer lending is that it is a long-term investment. Okay, so you've loaned out money on a peer-to-peer site, and now you're starting to see the returns. Problem is, the money that you're seeing as a return on the screen, you can't get liquid for 3 to 5 years, unfortunately. So even though you have money, technically, you don't have money. If you want to get your money out early, you'll have to pay a penalty percentage on what you've earned. And there is another downside on that as well, and that's taxes. Income received through the peer-to-peer market is taxed as normal income. You don't get any special tax statuses as you would with an investment such as the stock market. So with all of this being said, is peer-to-peer lending a solid investment? Honestly, there are a lot of variables to determine this: risk, amount of the investment, time to maturity, return, and etc. If nothing else, it's an investment opportunity and a new way to diversify your portfolio or add additional passive income if you're looking for that. As with all investments, it's best to do your due diligence on the investment institution, their policy and guidelines, as well as the borrower data and vetting information that you can find on them before making an initial investment. For me, it's a solid investment. I'm adding it to my portfolio with the thought of long-term growth as well as diversification. Guys, I hope this information on peer-to-peer lending has been helpful, informative, as well as educational. If it has and you enjoyed this video, be sure to smash that like, subscribe, and don't forget to ring that notification bell so that you'll get updates on future content and videos similar to what you saw in today's video. And always remember, guys, there is no goal that is unobtainable when you apply everyday finance. I'll see you guys in the next video.